This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers property insurance, health insurance, disability insurance, and life insurance. Life is full of risks. You can try to avoid them or reduce their likelihood and consequences, but you cannot eliminate them. You can, however, pay someone to share them. That is the idea behind insurance, risk sharing or risk shifting. Typically, property insurance covers loss of use from either damage or theft, loss of value or the cost of replacement, and liability for any use of the property that causes damage to others or others' property. For most people, insurable property risks are covered by insuring two kinds of property: a car and a home. Loss of use and value can occur from hazards such as fire or weather disasters, and from deliberate destruction such as vandalism or theft. When replacement or repair is needed to restore usefulness and value, that cost is the cost of your risk. Liability is the risk that your use of your property will injure someone or something else. Ownership implies control of and therefore responsibility for property use. Liability takes three forms. Negligence is the failure to take the usual precautions. Strict liability is responsible for intentional or unintentional events. And vicarious liability is responsibility for someone else's use of your possessions or someone else's activity for which you're responsible. Many people do not realize it, but if they allow someone else to drive their car, they are responsible for that person's actions. Homeowners insurance insures both the structure and the personal possessions that make the house your home. For those who rent, renter's insurance protects your possessions even though you are not the owner of your dwelling. Homeowners insurance policies automatically cover your possessions for up to 40% of the house's insured value. You can buy more coverage if you think your possessions are worth more. The benefits are specified as either actual cash value or replacement cost. Actual cash value tries to estimate the actual market value of the item at the time of loss, so it accounts for the original cost less any depreciation that has occurred. Replacement cost is the cost of replacing the item. For most items, the actual cash value is less. If you own and drive a car, you must have car insurance. In the United States, financial responsibility laws in each state mandate minimal car insurance, although what's minimal varies by state. Bodily injury liability refers to the financial losses of people in the other car that are injured in an accident that you cause, including their medical expenses, loss of income, and your legal fees. Injuries to people in your car or to yourself are covered by medical payments coverage. Uninsured motorist protection covers your injuries if the accident is caused by someone with insufficient insurance or by an unidentified driver. Property damage liability covers the cost to other people's property from damage that you cause, while collision covers the cost of damage to your own property. Collision coverage is limited to the market value of the car at the time. To reduce their risk, lenders financing your car will require that you carry adequate collision coverage. Comprehensive physical damage covers your losses from anything other than a collision, such as theft, weather damage, acts of nature, or hitting an animal. Auto insurance coverage is limited depending on the policy. The limits are typically stated in numbers representing thousands of dollars. For example, 100, 300, 50 means that $100,000 is the limit on the payment to one person in an accident. $300,000 is the limit on the amount paid in total for all people per accident. and $50,000 is the limit on the amount of property damage liability that can be paid out. Minimum auto coverage in Illinois is woefully inadequate for major accidents. The minimum coverage for 2011 is 20, 40, 15. If you have an auto accident that exceeds your coverage, you can be held personally liable for the additional costs of the accident. That is why I strongly recommend buying coverage that exceeds the state minimum. The additional cost is usually very small. A few years ago, I increased my coverage significantly beyond the state minimum to protect my personal assets in the event of being sued after an auto accident. The peace of mind that I gained was worth well more than the 8% increased premium I had to pay for the increased coverage. Typically, health insurance combines basic insurance, which covers seeing a physician, surgery, hospitalization, and some sort of prescription drug coverage, with major medical, which covers serious injuries or illnesses. Dental insurance can be added to the plan or purchased separately. Most dental plans offer coverage of preventative office visits and services, such as dental cleanings, with some coverage for other dental work. Health insurance costs have risen at a rate significantly greater than the inflation rate for other goods and services. As healthcare costs and insurance premiums rose, insurers added cost offsets. Those offsets may include deductibles, which are an amount payable by the insured before any expenses are assumed by the insurer. Copays, which are partial payment for certain costs, for example, for physician's visits or prescriptions. And coinsurance, which is shared payments of expenses by insured and insurer. All of these lower the cost of the policy. By forcing consumers to share in the costs of care, it is hoped that consumers will make wise choices, keeping the costs of care lower and policy rate increases to a minimum. The two most familiar kinds of insured managed care are health maintenance organizations, otherwise known as HMOs, and preferred provider organizations known as PPOs. An HMO directly hires physicians to provide preventative, basic, and supplemental care. A PPO does not directly hire physicians, but instead negotiates discounted rates directly with healthcare providers in exchange for making them preferred providers for members seeking care. Care by physicians outside the network of PPO providers may be covered, but with more limitations or higher copays and deductibles. In exchange for offering the flexibility of more choices of provider, the PPO charges a higher premium than the HMO. This chart shows Illinois in comparison to the United States. You can see in the chart that employers play an important role in providing health insurance. As health insurance costs have increased, employers often have to make difficult decisions about the health insurance policies they provide, as well as the employee contributions to the health insurance premiums. This chart from the Kaiser Foundation shows that health insurance premiums for family coverage rose from just under $11,000 annually in 2005 to just under $14,000 in 2010. Employers picked up some of the increase, but employees had to pay $1,284 more for coverage on average in 2010 than they did in 2005. The federal government, in concert with state governments, provides two major programs to the general public for funding health care: Medicare and Medicaid. Medicare was established in 1965 to provide minimal health care coverage for the elderly. Medicare offers hospital, Part A, medical, Part B, combined medical and hospital, Part C, and prescription coverage, Part D. Medicare is really a combination of privately and publicly funded health care. The optional services all require some premium paid by the insured. Medicaid was also established in 1965 to provide health care based on income eligibility. It is administered by each state following broad federal guidelines and is jointly financed by the state and federal government. This means that states differ somewhat in the benefits or coverage they offer. If someone is covered by both Medicaid and Medicare, Medicaid pays for expenses not covered by Medicare, such as copays and deductibles. Together, Medicare and Medicaid pay about 60% of all nursing home costs. Disability insurance is designed to ensure your income should you be impaired after surviving an injury or illness. It can be purchased from many companies and is sometimes provided by your employer, although usually only very minimal coverage is provided this way. The definition of disability is a variable feature of most policies. Some define it as being unable to pursue your regular work, while others define it more narrowly as being unable to pursue any work. Some plans pay partial benefits if you return to work part-time, and some do not. Be sure you understand the limits of your plan's coverage. Life insurance is a way of ensuring that your income will continue after your death. If you have a spouse, children, parents, or siblings who are dependent on your income or care, your death would create new financial burdens for them. To avoid that, you can insure your dependents against loss, at least financially. The amount of coverage you should purchase depends upon what you want it to pay for. Several common considerations are listed here. Term insurance is insurance for a limited time period, usually 1, 5, 10, or 20 years. After that period, the coverage stops. It is used to cover financial needs for a limited time period, for example, to cover the balance due on a mortgage or education costs. Premiums are lower for term insurance because the coverage is limited. The premium is based on the amount of coverage and the length of the time period. Whole life insurance is permanent insurance. That is, you pay a specified premium until you die, at which time your specified benefit is paid to your beneficiary. The amount of the premium is determined by the amount of your benefit and your age and life expectancy when the policy is purchased. Unlike term insurance, where your premiums simply pay for your coverage or risk shifting, a whole life insurance policy has a cash surrender value, or cash value that is the value you would receive if you canceled the policy before you die. You can cash out the policy and receive that cash value before you die. In that way, the whole life policy is also an investment vehicle. Your premiums are a way of saving and investing, using the insurance company as your investment manager. Whole life premiums are more than term life premiums because you are paying not only to shift risk, but also for investment management. That concludes this presentation. I hope you enjoy reading the chapter and learning more about insurance.